Hey everyone, it's Rick and Michael from Heirloom Wealth Management. This is probably the most covered topic that we discuss. And I'm going to preface this by saying we're not tax professionals. We should know a little bit about this, but anything we talk tax related, just clear through your CPA. But we get asked constantly about, should I be doing Roth, which is, tax now and never again, Roth contributions for your employer workplace.
Never again, not as it grows, and not when it's withdrawn.
Yeah. So it's taxing the seed, not the harvest. The other side of that is pre-tax, your traditional 401k, which you think of normally, which is you get the tax deduction this year because you're going to be assumingly in a lower tax bracket later, and you pay the ordinary income when you withdraw that from that account. So most people think about a 401k or their IRA, they think pre-tax deduction, great, they don't have to pay tax on it this year, they'll pay it later. That has been challenged a little bit, and for a couple of reasons, and we're kind of in the, we've been in the Roth boat since 2018 pretty hard. So what I mean by that, to give you some context here, is right now we are in some pretty interesting tax brackets where you're in the 24% tax bracket, you're in the 22 and the 12 below that, but you don't exceed or get out of the 24% tax bracket until like $364,000, and that's before you add on your standard deduction, which can add another $27,700. So you're talking about almost $400,000 before you eclipse or go outside of the 24% tax bracket.
Marginal tax bracket, yeah.
Yeah, marginal. So not everything's taxed at 24, but just the part that you went over. So when you look at like, okay, does it make sense to take a deduction now or later? We're really in the sense that, I mean, for most people that don't make over $400,000, we would say you should still be doing Roth contributions into your 401k. If you're under 50, you can do $22,500 this year. Your employer can put some money in there. If you're over 50, you can do another catch up for another $6,500, whatever it is. So you've got some good money you can put away there at a 22 or a 24% tax rate. To go back to 2016, I mean, where were you in 2016, right?
So for a married couple filing joint in 2016, you were at the 25% tax bracket from 75,000 to 151, 28% from 151 to 231, and 33% from 231 to 413.
Okay.
And yeah, I mean, the difficult part about this conversation, we don't know what's going to happen in the future.
We have no idea.
Tax
I don't have a
rates.
crystal ball.
But we do know that that was what the tax rates were in 2016. If legislation is not passed to extend our present tax code, by the end of 2025, we are reverting back to the old tax code. Now, it'll be a little bit better because they'll index it for inflation. But, that aspect of it combined with, what I foresee is an environment where we're likely to see tax increases, broadly speaking, overall, just because of the amount of, debt that we're dealing with, deficits. It just, to me, this is a golden opportunity as we may ever have. Yeah. Meaning between now and 2025, and we've been recommending this where appropriate over the last several years to make Roth contributions, and maybe another video that we'll put out, but on certain circumstances, even Roth IRA conversions, to take advantage of the tax rates we have today.
That old thinking comes from well, when I retire, I won't be making as much, so I'll take the money out of a lower tax bracket. With the current tax brackets, what they could go back to, we have no idea what they could go back to. That's not necessarily true anymore. We teach classes. We say, hey, who thinks taxes are going down? I don't think anyone has ever raised their hand saying they think taxes will get better. It'd be great if they did, but highly unlikely. So just think through a scenario in which you're married, you both have decent incomes for most of your life, you've got some decent Social Security coming in, you've waited until 70. It's pretty common for us to see $80,000, $90,000, $100,000 projections for joint income coming in there. Now, 85% of that is tax, but you've still got $80,000+ coming in if you don't have anything else.
Required minimum distributions on traditional IRAs.
Yeah, then you have that. Plus, you've got this massive, defined contribution 401k plans that people have had to put in because there's less and less pensions. But you've got your required minimum distributions, which will be another video. But that's money you have to take out. much less you need to take or want to take out. So if you want to do anything fun at all, if you want to travel or anything, and the only bucket of money you have is a pre-tax IRA from a 401k, if you're already at 80, 85K in Social Security and you go back to those tax brackets, you're 25 plus. You have no control over your tax brackets. Even worse, RMDs kick in when you're 73 and 75 in the future, and you have to take the money out. So you really have no choice. So tax diversification in having another bucket in Roth is super important. In fact, we'd really try to get people to, if we can, to a half and half mix, because you want options of where you take that money from. But
well, especially at a 24% tax rate.
Yeah, I mean,
most people are going to be above $75,000 of income in retirement, and if we revert back to that tax code, if Congress and they can't agree to extend the present tax code in 2025, which it doesn't seem like they can agree on anything, what day of the week it is, then we're going back to that. Or potentially even worse. It could get better. We don't know that, but I think the odds are that we're either going back to what we had before or something potentially worse. At which point, $75,000. Most people, they've got a decent IRA nest egg, 401k nest egg, Social Security. They're going to be above that, so they're going to be in 25% tax bracket, federal marginal tax rate.
It may seem crazy. It may seem crazy to take tax now at 350, but I don't think that's going to be a decision you regret later on. So,
one final point that I'll throw in there is that from a legacy planning perspective, the heirs are able to inherit the tax treatment for these accounts. And so, if we're talking to somebody that's 65, God willing, they have another 30 years to live, and part of their goal is to bequeath some of the money that they've accumulated to their heirs. It's like, all right, we got a 30-year runway to grow this. And the way that the inherited IRA works right now is they can invest it another 10 beyond that, and we can put it in a tax-free account that can be grown tax-free, spent tax-free. Wow, what a powerful generational wealth building tool that can be.
Yeah, there's almost like a tax trap right now with the amount of money that people have to self-fund their retirement with. The RMD ages getting kicked back to 73 and 75. The elimination of having your heirs being able to take it out over their lifetime and more in that 10-year window they have now. It's almost like this tax trap that people don't see coming, like boiling a frog.
I mean, it's super common when we meet with a prospective client that's diligently saved their whole life into a 401k, accumulated a nice nest egg, 7 figures, $1.5 million in 401k IRA assets. And we'll look at their financial plan, and with Social Security, IRA distributions, we're north of 6-figure taxable income in retirement. It's like, wow, great job saving. But, if we don't do something to mitigate the potential tax trap that you're going to have once you're 70 plus years old, you might look back and wish you might have done something.
Yeah. Roth up to about 400. That's the takeaway. I'm Rick. That's Michael. We're Heirloom. Hit subscribe below and we'll talk to you soon. Hey guys, if you like that, click here or here to see other videos that we've recorded, and we'll see you soon.